What should be foremost on investors' minds as we approach 2020? Lots of volatility out in the world.
Well, it's certainly going to be a year of slower growth. You had some vulnerabilities in the U.S., low unemployment, full employment in a sense. Clients not being able to pass on these extra costs, so the margins are squeezing, high corporate debt. So altogether, some weaknesses there. Then you get the trade war, which has hurt growth both in the U.S. and in China. We can talk about it a bit more. But then that has really spilled over in the world, the sentiment in the world, the willingness of companies to invest and to do capex. And that, I think, altogether will take 0.5 to 0.7% of growth of global growth.
Now, markets have been a little bit optimistic that this next round of talks, which begin in Washington this week, today, if I'm not mistaken. However, the little cold water has been poured on that. A new report out from the South China Morning Post saying the deputy-level talks have yielded no progress. Those reports are unsubstantiated, however, because they don't have attribution to who's making that assessment. So we don't know necessarily until the high-level talks begin. But what are you hearing from your clients? How concerned are they that this is going to be it's already been a protracted dispute?
Yeah. Well, clients think most likely it's going to be a small deal, so it's not going to really resolve the whole issue. So we see clients around the world preparing for a world where they have to live with this tension. So you see definitely shifting of supply chain. You see people moving their production to try and be more resilient to any of these sort of trade problems that are there and that may continue to exist for quite some time.
Do you think a scaled back deal is better than no deal?
Yeah, I think that will bring some peace of mind. But again, I think people need to prepare for a world where we have more trade tensions than less. You see that not only in China, US, but you see overall a rise of sort of nationalism, and I think that will lead to people preparing for a world where they need to, for example, produce locally so they can avoid some of these critical import-export channels.
So how is it impacting what JPMorgan obviously wants to do in China? We've heard Jamie Dimon talk extensively about wanting a wholly owned unit here in China with the JPMorgan logo on the skyscraper and the like. We got in March approval for your securities joint venture, of course, to get at least majority control. We could hear that by 2020, by next year, you could apply for 100%. Does the trade tension, though, make you have pause?
Not at all. I think that China is a once-in-a-lifetime opportunity for us. There's never been a place that's so big compared to our own home market, and so we are leaning forward in terms of investing, and the current trade dispute is changing nothing to that. So, yeah, we want to be on the ground continuously every year, adding people and adding capabilities. So, having your own securities firm is part of that.
So you're saying basically being onshore would be more beneficial than not?
I think onshore in all countries, well, not all countries, but all relevant countries, that is our view on life and our mission in life. We want to service corporates that do business around the world. And for a lot of companies and clients of ours, China is hugely important. So we want to be able to service them here with all the needs they have.
What is your corporate's risk or your client's risk appetite right now then?
Well, globally it's less, and that's what's been shown by the significant reduction in capex. This is really a key driver to the global slowdown in growth. But with respect to China and emerging Asia, that's still the region that's growing the highest in the world. It's growing at 2 times the speed of global growth, 2.5 times the US, 4 times the speed of growth in Europe. So this will continue to be a place where people invest, including in China, where I think clients are trying to be more on the ground so they can produce locally and avoid some of the tariffs that may be in place.
Do you see, though, that this is going to be a protracted fight? This is not just something that's going to be resolved in the next year. This is something maybe what some have called the new normal.
Well, I think there was a time when we thought it would be resolved before the U.S. elections because we thought it would be beneficial to both the U.S. and China to resolve it quite quickly. But I think we've learned that the issues are deeper. And I don't think anyone sees a clear clean path out. So I think we'll have to live, hopefully, with a smaller deal, but still with some limitations in place that will continue to linger in the background.
Now, you're based in the Middle East, in Dubai, I believe. A number of flashpoints there as well, with the tensions with Syria, of course, what's happening there, with the Saudi-Iran tensions, what's happened in Iraq, the tension down in the southern Iraq, which is a big oil-producing region. Could this be the new flashpoint for the oil markets right now?
I've been living there for 7 years, and we've had geopolitical issues throughout these years. They flare up from time to time. I think they're manageable, to be honest. I think the bigger thing is oil. With global demand slowing, no doubt next year, oil will come under pressure. Now, obviously, it's beneficial to some countries, but for that region, it's not necessarily helpful. So they have this transformation they're going through, economic transformation, particularly in Saudi, but there'll be less money to support that.
How about quickly on the Fed? What do you? I mean, they seem to be split with the latest minutes being released. Would progress on the trade front lessen the pressure to cut further? Already 2 cuts.
Yeah, I will pre-qualify that with saying I'm not an economist. I mean, I'm just floored by the change that we're looking. Last year at this conference, 10-year rates were 10%. We worried about rate hikes. Today it's at 1.5%, and we are talking about how many rate cuts, not whether there are rate cuts. So, yeah, listen, if the trade war has an impact on global growth, and we definitely believe that, then it's obviously also going to be an input to the Fed.